One of the most common questions that I get as a life insurance agent is how much should I actually put into a whole life insurance policy? Specifically, when the question is rooted in how much should be going into an overfunded whole life insurance policy. And while it sounds like it should be a very simple answer, the truth is it really depends entirely on you. And a lot of people that come into a conversation with me may think that there's a standardized minimum or maximum that's across the board, similar to other retirement accounts or something like that. And if I'm in a conversation with someone about overfunded whole life insurance, the real question is about your ability to fund the policy consistently and whether the dollars you're already saving in places like bonds or savings accounts or 401ks or brokerage accounts, whatever, are really giving you the result that you want. And one of the things that I think is helpful to add as well is that if you're asking this question of what's the minimum that you can put into a policy, I would say that in some ways you're kind of asking the wrong question because that, in my mind, does assume that you may only want to contribute just the minimum. And if somebody is dead set on that as the goal, or that's just really what they want to think through and talk about, it's probably better for that person to not get a policy from the very beginning, especially if their goal is cash value accumulation. And so I have had a situation where someone wanted to know the minimum cost for a permanent amount of death benefit, and there was a specific number of death benefit. In his case, it was just over $2 million. But in his particular case, he also wanted the option to pay more in paid up additions in order to grow cash value. And I would say that's a completely different conversation, which perhaps I can make a video on that at some point in the future. But back to the main point of this video. Instead of trying to kind of figure out generalities of a policy, it's usually better to just try to get really specific, which can be hard to do here in a YouTube video. So if you want to get a better feel for what your real numbers could look like, go ahead and just schedule a free call with me, shoot me an email, because I would want nothing more than to show you and narrow in on something very tailored to you specifically. Because it really shouldn't be about what everyone else is doing, but instead we should be starting with what can you specifically, what can you realistically save every single year, even through tough years potentially. Then from there, what we want to do is align that with your bigger goals. That's super important because the reality is people don't fund policies like this just for the sake of funding them. They fund them because of what the cash value can do for them, what the cash value can do for their family, what the death benefit can do for their family in the most efficient way in order to accomplish a particular result or an outcome. And so for some people, what that looks like is, it's a retirement income target. For other people, it's building a safety buffer outside of the market. For other people, it's all about opportunity. Okay. It's all about opportunity for businesses or other investments that they have going on that they plan on investing in at some point in the future. Right. The list goes on and on in terms of the core purpose and core reason why someone ultimately ends up wanting a policy. And either way, your ability to fund the policy is what determines how effective the policy will be in relation to the outcome that you're looking to achieve. And so narrowing back into the policy in and of itself, I want to go ahead and just show you an example of a few very similar policy designs and the flexibilities within those policies, because perhaps this could be helpful for you. If you're in this place where you're wondering, like, again, how much should I be putting into a whole life insurance policies? Like, I've literally myself worked with hundreds of clients, and they have typically found it very helpful for me to show them a few different options, for me to show the flexibilities of the policy and the fact that your contributions are not only flexible in such a way that you can contribute less when life happens, but you can also contribute more if it's set up correctly from the very beginning. So without further ado, let's take a look at it. All right. So in this first example, what we're going to be looking at is someone contributing $30,000 per year for 15 years. And just to give you a little bit of context behind the person in and of themselves, first and foremost, Preston Profit is not an actual real person, just so that you know. But this person that we're looking at for today's example, we're looking at a male who's age 40, and we're looking at the very best health rating, and they are non-smokers. They're non-tobacco. Okay. So in our initial conversations, ultimately, this person in particular wanted to contribute somewhere in the neighborhood of $30,000 per year into the policy. In other words, that's where they were contributing some dollars to the brokerage, but a lot of that was going to bank accounts year over year over year, generally speaking, and that's on the conservative end for this particular person. And so we showed 15 years because the gentleman doesn't necessarily want to have to contribute for years and years and years and years for the rest of his life, although there is some flexibility that we can always talk about with regards to how long you'd like to fund. Okay. So in this particular case, very efficient policy, right? We're looking at, $24,870 of cash value in the first year. These are all end of year values. And by the 15th year, $450,000 has gone into the policy. And we're looking at almost $200,000 more than that at that particular point in time, which is pretty solid given the fact that this is a very conservative place to store capital and utilize it without stunting its growth and all of that. Okay. And so one of the things that we ended up talking through is the simple fact of like, okay, what's the minimum? What's the maximum? Can I contribute more? And so in this particular illustration, this number that you see here is $5,669. That so happens to be what that minimum contribution is, which is nothing more than a makeup of the base contract premium and the what they call the FPR contract premium at this particular carrier. That is nothing more than the term insurance rider, which increases the death benefit to a point that justifies the level of overfunding that we're doing, right? And then we have quite a bit of paid up additions going into the policy as well. But this number plus this number gets us the $5,669 that we see down here, right? So even from years 1 all the way to 15, there still is that wiggle room of maximum $30,000, minimum $5,669. So as conversations continue to go, the question becomes, well, hey, Demetrius, is there any way that I could contribute more than $30,000? And I go, well, no, not with this particular policy. But would you like to understand how that could happen if you wanted to do that? And he said, of course, let's take a look at it. And that leads me to this policy here. In this particular case, we're looking at $30,000 of contribution per year once again, which looks exactly the same as the other policy that we were looking at. The only difference here is that instead of that minimum contribution being the $5,669, now what we're seeing is that the minimum contribution is $7,559. So the question becomes, why? Why is that the case? The reason this is the case is because I'm literally showing a $30,000 funding level when, in fact, this particular case gives you more room to contribute more if you want to. And so in this case, for this same gentleman, he's actually able to go all the way up to $40,000 per year. And so if he never contributes more than the $30,000 per year, this is not going to be the best move for him, because take a look at the cash value. If you look at the cash value in year 1, we're looking at $23,696. Whereas if we looked at the initial one, we're looking at $24,870. So it's like not that big of a difference when you account for the fact that you can contribute more. But if you never contributed any more to the policy than $30,000 per year, not that great of a move for you. Why? Because at the same point that you've contributed $450,000 by that 15th year, you have $638,000 available by this point in time, compared to the $645,000 that you would have had if you would have allowed $30,000 to just be your maximum. And so as the conversation continue, ultimately what we end up talking through is the fact that, like, hey, there's a reasonable expectation that I'm going to be able to contribute more than the $30,000 in some years. It just may not be every year. And so in that particular case, I wanted to just kind of show an example, and I'm showing you guys an example of what would happen to the cash value if he only contributed up to that $40,000 just one time. So in this particular case, we're showing $30,000 per year for 2 years. And then in the third year, we're seeing $40,000, and then we're just keeping it level at $30,000 per year moving forward. And keep in mind that minimum premium still is a little bit higher. So by him doing that just that one time, clearly in that particular year, by that particular year and moving forward, there should be more cash in the policy, especially compared to this one. But is that the case compared to the very first one that we looked at as well? So let's take a look at this one. This is the one where he put in the $40,000 that one time. 15 years down the line, just to give us some area to look into, $460,000 has gone into the policy. He now has access to $657,000. So $10,000 more in contribution resulted in about $12,000 more of cash value in his policy by that point in time. And just imagine if he continues to contribute more for a longer period of time. So if he did that for 2 different years, what's the result in this particular case? Clearly, he's going to have more cash value. And as we can see, by contributing an extra $20,000 over that time frame, he now has $675,000 available by that 15th year, as opposed to the $645,000. Okay, so just to kind of give you an idea of what that would look like, and how for that particular person, the idea here was to borrow against it for opportunities that may present itself along the way. while also being able to utilize it long term for maybe a supplemental retirement income play. And at the same time, he wants the ability from a funding perspective to have flexibility to contribute low while also contributing a higher amount up to that $40,000. So the big question and the big kicker for this particular case is, are you comfortable with the $7,500 minimum of annual premium per year? In this particular case, again, he's normally contributing $30,000 per year to other accounts anyway. And so, yes, he's way more than comfortable with the $7,500 minimum. And what I showed you there is just one example of hundreds that I've been able to kind of help people with over the years. And so when designed correctly, when designed with your goals in mind at the very forefront of every conversation, when you redirect cash flow from where you're already going to be saving it into something that grows tax advantage, is available tax free to you, and comes with protections like the death benefit, paid up additions to increase your death benefit over the years, not only just with the cash value, which we talk about a lot, but also a bunch of other living benefits, right? That I may get into in another video, perhaps. When you do that, you're just positioning where you are already going to be putting capital into a place that just gives you way more benefits across the board. And so this real answer to the question of how much should I put into a policy is always going to depend on you. It's always going to be a very personal and personalized approach to a conversation that we're having. And that's why it really helps to talk it through with someone who's done this quite literally hundreds and hundreds of times. So if you're wondering and still thinking to yourself, like, how much should I be putting into a whole life insurance policy? Please remember this, okay? It's not about finding the perfect number. It's about aligning your savings ability with your goals. And so if that resonates with you and you want to find a better place for your money that you're already setting aside, it might make some sense for us to have a conversation, which can be scheduled very simply and for free by using the link in the description or the pinned comment. And if you got anything out of this video, or maybe you learned something new, go ahead and give the video a thumbs up. It really helps more people to see it. It gets the word out there to more people. And if you want to keep learning about overfunded whole life insurance and how to actually use it, go ahead and hit the subscribe button for more videos just like this one. And again, for those of you who are ready to see what this could mean for you personally, there's a link in the description where you can book a time directly with me. Thanks for watching. I'll see you in the next one.